Good morning. My name is Donald Fleming. I'm a partner in RSM's Covenant Assessment Services team in London. And the subject of the webinar this morning is IRM, Integrated Risk Management, which is a very topical area. And I hope to share some thoughts with you about how I and my colleagues are experiencing this and where we see it going. So if I turn to the first of what we're going to cover in this session, what we're going to look at is the scheme's key financial risks and just a little bit of deconstructing a pension scheme from a financial perspective. And then looking at what the key concepts are around IRM, the language being used. And then stepping back and thinking, well, why do we think this is important? And to what extent is this being driven by the Pensions Regulator? And where is market practice going on this? And how is it actually working? How are schemes and sponsors, with their advisors, carrying out IRM in the real world? Then I'd like to talk a little bit about how it's developing and some of the direction of travel. The overall thing that I would like to bring out is and this is, I suppose, to preempt the question is sometimes asked of isn't this just an add-on? Is this just another thing that we, as a body of trustees, have to deal with? And what I'd like to suggest through this webinar is actually IRM as a way of looking at a scheme and a company together. And it's more about a fundamental process by which a pension scheme is run than an add-on. So if we look at it through that sort of lens, what I'd like then to turn to is the first topic, really, which is the scheme's key financial risks. Now, pension schemes face a host of non-financial risks, and IT, cyber risk, will be covered, and we have covered those, my colleagues, in other webinars. So what we're zooming in on this one is really just on the key financial risks. That underpins what we're focusing on through IRM. So if we look at a pension scheme in terms of cash flows, you have the funding from employer contributions, the funding coming from investment returns, and the idea is broadly that this is sufficient to cover the projected payment of the scheme's benefits and the costs. So you've got these three broad thematic types of cash flow, which, with the help of the various advisors and people around the trustee board table, are being tried to be aligned. And that's the challenge, really, that IRM is addressing. So IRM is about risk assessment. It's a risk management tool, and that's the language that the Pensions Regulator used through its consultation. And it's about looking at the risk in the round. So a lot of attention over the early years of the 2004 Pensions Act regulatory framework with the establishment of the Pensions Regulator. A lot of that was around looking at things to an extent, because it was the art of the possible, looking at things in silos. So from a covenant perspective, my personal experience was that covenant tended to be dealt with often in a subcommittee, and the interaction with the other areas was in many cases quite low. That was the early years, and where things have obviously evolved over that time, and people are now beginning to look at risk and looking at the key areas together in the round. And the regulator asks trustees to look at pairs of risks and to look at risk correlations and looking together. We'll come on to that in a minute. The other thing is that given those long-term cash flows and the long-term nature of a pension scheme's liabilities and the long-term nature of the responsibilities on a company to support the pension scheme, that when you look at it through the lens of risk, you cannot just say this is a one-off exercise. We do this, lock it away, and that's dealt with. Because nothing is static. Everything is dynamic in this area. Then the other thing is I suppose the language of IRM is beginning to permeate some of the discussions that pension scheme trustees and sponsors and advisors are having. People are talking about risk capacity, the capacity that a particular entity has to take risk, the appetite that entity has for risk, and what might happen if those risks eventuate, what its exposure is. And as recognised by the Pensions Regulator, risk is rather like something under the rug. You push in one area and it'll come up somewhere else. Risk never disappears. It's transferred and it's managed. So if you look on the right-hand side of this slide, really what we're saying is it's important because when we identify the risks, how do we deal with that now? What should we be doing? We should identify the key risks. There's only so many things you can do, and you have to, as with everything, have to prioritize. So don't try and boil the ocean. Don't try and pin down every single risk. It's trying to prioritize what are the key risks and how have you dealt with those. The value is in the process. It's not about a number popping up at the end, because that is essentially a static thing and numbers change. And it's all about how did you come to a number? How did you address risk? So it might seem that it's a never-ending thing if I'm saying it's an ongoing process, but that is part of the value of looking at life through the IRM lens. When I mentioned the silo mentality that had pertained in previous years, my personal experience as a covenant practitioner is I'm very pleased that in many cases pension scheme trustees sit around the table and there is a collaborative approach between all the parties. And so the advisors are often asked to go away and come back with a coordinated piece of advice that brings together all the issues and the experiences that the advisors each have. And there are all sorts of ways that different firms, different individuals will use to inform that kind of discussion. So conventionally, for instance, there is a risk register that pension schemes will maintain that will be item number 1 or 2 on many schemes, governance and board minutes. I look through that, but IRM is really taking that to the next level. It's saying what kind of tools might you be wanting to use to look at risk in a more cohesive way. And we'll come on to scenario analysis, but obviously there's a range of things. The fact that risk is dynamic implies, therefore, that IRM is about contingency planning, and it's about clarity of decision making. So when you're regularly monitoring a risk, and the level of degree of frequency that you might have for monitoring really will depend from situation to situation. Depends on how healthy the company is, the interaction between the corporate and the trustees, the information flow. There's no right or wrong answer here, but it has to be informed by an appropriate level of keeping abreast of changes in risk. And that's what covenant monitoring is about, but it's also tying in with monitoring of the investment performance and the liabilities. So it's all the advisors bringing to the piece on an ongoing basis, not just locking it away. And I think one thing which people are now beginning to talk about the triennial valuation as being, less of a big set piece, because technology and approaches are enabling boards to keep discussing these sort of things between valuations. So it's just not a large one-off exercise that's then locked away in a desk for 3 years. And it's a collaborative exercise. It's thinking about risk. So from a pension covenant perspective, for instance, practitioners often discuss covenant risk in terms of a strong covenant or a weak covenant, or the ability to bear investment risk. And when you look at life through a risk framework, you're saying this is the covenant we have, and it is posing a risk which you might characterize as strong or weak. But it's not a judgmental view about a company. It's about what degree of risk is being taken by each of the parties. So language is important, because language can be emotive sometimes. And I think that's where practitioners are developing a more informed and perhaps a more perceptive discussions that are taking place between schemes and sponsors. But there's still a long way to go. The Institute and Faculty of Actuaries has done a great deal of good work on integrated risk management, and in a 2017 guide, they commented that most trustees and advisors consider funding issues when setting investment strategy and vice versa, but fewer fully integrate covenant into their decision-making process. Covenant risk underpins that, so it needs to form a regular part of trustee discussions and analysis. So there is a way to go. From my perspective as a covenant advisor, I would say there's still a way to go here, but the direction of travel is looking good. The Pensions Regulator is very much promoting the concept of integrated risk management, and particularly when they are involved with proactive engagement with schemes where they are getting involved. And they have said they expect trustees to focus on integrated management of the three broad areas of risk. That's covenant, funding, and investment risk, and that they apply an integrated approach when they're assessing the risk profile. So when we're talking about the language, if the regulator is looking at life on this basis, then it obviously makes sense for pension schemes and companies to be looking at life through that same sort of lens, to know how their regulator is approaching it. So what the regulator has done is to set out a suggested framework, and so there's useful information on their website of this. And what I've done here is just represent it in practice, in a sort of wheel, circle approach, to get across that it's not just a linear thing, this is a process. That these are the key steps that the regulator and has set out a framework, and it's quite a good one of approaching it. First one is you set out the governance framework. What are the objectives? How is it going to be run? And this is where practicalities are important. Trustee boards have a lot on their plate. Some have a range of subcommittees. Some operate on a much more full board basis. You've got, on an IRM basis, you have to find a way of someone having ownership of that. And we would say that ownership of IRM should be a trustee-led matter, to bring in the advisors, to make sure that the advisors work collaboratively together, bringing in their different skills and experience. But it's very much a trustee thing. So a governance structure is important. And then it's about identifying the key risks. And I've touched on some of the approaches that people But that's really sort of focusing on what are the risks. And then it's asking the advisors to work with the trustees to assess those risks and to put them together in different ways to see what comes out of that. And after having really evaluated those risks, then it's about managing them. So people have decided what kind of risks they want to bear and what their risk capacity is, what their risk appetite for those is. And now they're in the management phase. They're saying, okay, well, there are some risks which we do need to focus on. And that's the sign of trustee boards approaching their job as a matter of strategy, where a scheme might be going in terms of risk management. And then monitoring that risk, trying to put plans in advance so that if there is a problem, it can be dealt with. And I think this is something where probably there is some difficulty, I suspect, in practice, because there is such a wide range of things that might happen coming out of a risk evaluation that you can actually put some contingency plans in place for some things, but there are still uncertainties. So you can never legislate for every single uncertainty, but what you can do is to try and work through what if this thing happens, how would we as a board address it? And that can be done through case studies, role-playing, and a variety of techniques. I've seen these work very successfully on trustee training days, for instance, where a couple of hours is spent having identified a key risk that's worrying the trustees, go through a series of what-if discussions and how might those risks be addressed. It's not what would the output be of how they would, in hard format, say what they would do, but it's how they would approach it. And it's opening up that, by the way, to an honest and transparent discussion around the table with the sponsor. A thing which I think sometimes is overlooked in integrated risk management is the parties to this relationship. Corporates are also looking at their own enterprise risk management, and they will, for the purposes of things like corporate viability statements and their own internal risk management, which is, there's often huge expertise internally around the company table, boardroom table, and they're doing a lot of work on that. So it makes sense for trustees and boards to work together to understand what each other's risk capacity and risk appetite is. So this is not a silo for the trustee to do without any engagement for the corporate, and vice versa. And there's some interesting work that's been done with the Financial Reporting Council and various bodies that are looking at disclosure of risk that each party has on those things. So there's quite a lot of thinking going on in this area. And then you want to document it. And a term that I would suggest is you might say, well, on one sheet of paper, or trying for that, how might you set out a statement of integrated risk principles? If you were to put it down on what are the key risks, how have you addressed them? How have you identified all of these? Not just for the record, but as a way of aiding your thinking. That can be very useful. Now, it's quite common in these sort of discussions on integrated risk management for people to present a pyramid or a circle with funding, covenant, and investment in the corners. And what this is getting at is these key financial risks. You remember I talked about the cash flows. So we're talking about the funding area, the ability of the pension scheme to rely on contributions and its funding contributions. The covenant risk, that is the company going to be there through the lifespan of this, where it might be paying these contributions, or it might have to rely on the balance sheet of the company. And the investment strategy, does that tie in with the risk that's been borne on the company to make good any deficit? So those are the sort of the key themes. And in the middle, you'll see that there are, again, various tools that practitioners, I'm sure some of you on this webinar will be having considerable experience with these sort of tools. So there's stress testing. You're looking at projected funding paths. You're looking at the investment field, the expected returns from the portfolio, but what might happen if in certain scenarios those expected returns were not to take place. Scenario testing is a very powerful tool. And from a covenant perspective, also you're looking at building in what kind of key measures and risk measures you might be looking at on a set of monitoring metrics. So in practice, there are a lot of tools available now. They are a wide range across the market, and they are increasingly being used conventionally by pension schemes with their sponsors. And so that's quite a development, I suppose, from several years ago, and that's all to the good. I thought, as a practical discussion point here, I thought it might be helpful just to come in on one of those, of taking a case study, really. So there's scenario planning. People talk about scenario planning, and some of you might say, well, what do you mean by scenario planning? How do you actually work this in practice? Well, stepping back, I like the analogy with the scenario planning with a vaccine, where actually something is put into a body, it triggers a defensive response, and the body learns. So if you take a couple of factors, what drives a company's performance? And then if you change those factors, what happens? And if it is quite significant, if it really moves the dial quite dramatically, then that's the sort of learning experience that you're taking from that. And what you want to do is to have this before the event actually takes place. So that's why I use this. It's not a terribly elegant analogy, but I was just trying to bring out the fact that we're trying to develop a learning response here. And then what happens if you follow through? The approach is to look at risks in pairs and then to put them all together in the round. And out of that, you're drawing together some quite powerful themes. So, for example, one that I was involved with quite successfully on a training session was the trustees of a utility asked all the advisors to go away and work through some reasonable scenarios that might be foreseeable in terms of the economic environment. And a particular one that was highlighted was an inflationary environment. So working through that theme, from a covenant perspective, what I did was having assessed the covenant and having quite a good handle on the cash flow profile of the company, was to work through an agreed set of assumptions on inflation and how that might affect the revenues and in due course the net cash flow generation of the group. So that was taking that scenario, using the same inputs on a range of inflation scenarios. The investment consultant was asked to think about what that scenario might pertain for the expected investment outperformance on the portfolio. And by the same token, the actuary was asked to consider the sensitivity of the liability assumptions to those preset ranges of inflation. Then we worked together very closely, putting those outputs together, and through a workshop with a subcommittee, a risk subcommittee of the trustees, thought through. That's the same assumptions. They've fed through to all of these. What did it do to the scheme's position from a risk perspective? And it was quite informative because it highlighted how a reasonable scenario of inflation might change all of those things together. And that had never been done before. And it allowed the trustees to focus on a certain number of inflationary scenarios, and actually to discount others that were less important from a risk perspective. So we looked at what moved the dial, and that actually was a very concentrated, small piece of work. And people will say, well, this is just another exercise for consultants to carry out things. Well, actually, what it did was it enabled, through that small couple of hours session, and obviously the preparatory analysis for it, but it allowed the trustees then to focus on what was important. And actually, some of the things that they previously had been doing, they didn't need to do. So net, everyone came away thinking that was really a great position to be in, and much more comfortable about where the risks were. So where do we think the direction of travel is? I mean, I suppose I'm talking to what does good look like, and I think I've just touched on what I think good looked like there. And I've touched on the way in which the actuarial valuation process is beginning to become more integrated with regular monitoring. And I've set out here a few thoughts about where pension schemes traditionally have worked, and where an IRM approach is beginning to take things. And of critical importance, I think, is the governance aspect. Now, from a governance point of view, the direction of travel is clearly for boards to be putting risk together. And we are, in a separate work and webinars, I mentioned cyber risk, for instance. And again, there's a non-financial risk, which has potentially massive financial ramifications. We're focusing on IRM really as financial risk with potentially massive financial implications. Boards do need to think strategically about how they put together all of their risks and address those risks. And that really, I think, is a challenge for the governance of a lot of schemes. But there is quite a lot of thought going in, I would suggest, by governance consultants about how this can optimize things. And well-governed schemes, some studies have shown, actually do outperform others. So this has a tangible output. And I think you cannot stick something into a model and say you have an integrated risk figure which comes out, and there you have it for 40 years. Because companies are run by people, schemes are constantly evolving, and life changes. So risk changes. You have inflection points at which suddenly a company might, for instance, change the strategy. There might be merger or acquisition activity. There might be a change in where the corporate structure is that supports the pension scheme. A host of different things. So that's why it's like steering a tanker. You're constantly having to adjust course over the course of a funding progression. And that's why all of these things have to be looked at continually. And then if you are looking at a particular progression, you're looking at what might be the downside and how do you deal with it. Equally, it's fair to say you're looking at what's the upside. And if things go better than planned, well, how are you going to react strategically to that? This is about risk planning. This is about people working hand in hand together to think, how do we deal with this? So that's the governance aspect. Now, that's the positives coming out of an IRM approach to life. From a funding position, in past years, there has been a focus, and there still is at each valuation, on the progress up to and hopefully through technical provisions. But the regulator has talked about the technical provisions just being a milestone on the way. And increasingly, the TPs are one factor, but they are by no means the only area, particularly where schemes are, in some cases, getting quite close to being fully funded on a TP's basis. So the strategic questions are changing of where next. Does the scheme run on? Does it move to settlement? Where does it want to go? And that's the new theme on the block, of course, is consolidation. And I would argue that when you're looking at whether a scheme might be better or worse off in a consolidation vehicle, you cannot approach that question without an integrated risk management approach. Because simply on an analytical basis, you're having to put all these things together because the pre and post condition is very, very different. From an investment position, this is what an IRM approach is recognizing that there's no such thing as a steady state. You can adjust your assumptions from time to time, and it's a more involved and a more, I think, sophisticated interaction that trustees are having with their investment consultants on a more regular basis, and a more interesting discussion that investment consultants are having with the actuary and the covenant practitioner around what contributions, for instance, might be assumed to be coming into the scheme over the next several years, and those would be invested. So to what extent is there an investable portfolio coming out of the next recovery plan? And from a covenant point of view, I've talked about how the language in terms of formal strength or weakness is evolving into a more nuanced discussion of risk, and how covenant monitoring should no longer be seen as just an extra, but actually it's increasingly the more important part of the piece, because you need to know what's happening between valuations. And I think that's bringing the direction of travel to a close. And so what I'd like to do is to open up at this stage to any questions. We have had some questions which have been given to us in advance. So I'll pass to the attendees. Really. One of the questions that was raised with us is surely this is beyond the resources of a lot of schemes, and I hope I've really demonstrated in the discussion around the case study and my comments that integrated risk management, if approached in the wrong way, yes, it's an extra cost. If approached in the right way as informing how a scheme looks at life, the lens through which you approach your funding discussions and your relationship with your sponsor, then actually it does make life more efficient, and you're getting better use out of your advisors. And there's a lot of skills there. I mean, there's a one which might seem obvious, but as a practitioner, I have noticed that in many cases, different advisors are pulled in for their slot of 10 minutes, 15 minutes, or whatever at a trustee board meeting, and not really encouraged to have discussions around what's going on. And that's how it used to be. And that can be quite counterproductive, because if you look at life from an integrated risk management perspective, if an advisor is being asked to say, or a consultant is being asked to say, this is the approach you should be taking strategically in relation to your investments or in relation to your funding progression, how can they give you an informed advice without having had a proper discussion of what the concerns are of the other advisors and the trustee board is? So actually, it does make sense from a governance perspective to have the advisors being asked to work together. That's a practical thing. Should appointing, another question came in, and this is rather one straight to the bone as a covenant practitioner. Should a covenant advisor be mandatory? And if so, what would the supervision or level of standards be? And I know this is, my argument would be it should not be mandatory for all cases. There has to be a common sense approach. An advisor has to bring value. So what it needs is an honest appreciation by a trustee board of where it's looking for input. So I would argue that in certain cases, however, it is important that trustee boards do have an mandatory advisor. And for instance, I've touched on scheme consolidation. And I do know in my capacity as chairing an industry body of covenant practitioners, we were discussing this very much the other night with people from the DWP as to how people do assess whether a scheme is better off going into a consolidation vehicle. And that might be a case where you do need to have some form of mandatory advice. But yeah, so I think horses for courses. Of course, I'd love to say there should be a mandatory advisor in all cases, but I think it's something where schemes really do have to assess where they see value, and then to take advice. Other questions really is about where do we think the Pensions Regulator is on its use of IRM, and I've mentioned earlier that the Pensions Regulator is using the language of risk quite strongly, both in its public pronouncements and in private communications with schemes, and that's something they are encouraging quite strongly, schemes to do this. When they originally put out the consultation around IRM, the consultation was phrased heavily in terms of sort of quantitative modelling and the approaches they're using. That didn't really see its way into the final documentation. And I think what's happened, I think the regulator has realised that there's the art of the possible, and that actually they were trying to do too much there, possibly. So they are clearly looking at life with this lens, and they are bringing together the themes. I don't think they're looking at it on a strictly modelled basis. I think they're still using quite a lot of qualitative judgment. And I think that's where the market is as well, really. Often a question which is put to us, and one of the questions which has been put to us about, this is quite a complex area, and where do we find out more about this? I think the TPR website and the various pieces of guidance and statements they've put out are very useful, because I touched on the framework that they've used. I think the actuarial profession has done some sterling work in this area, and so their databases for that, or their information on their websites. The Employer Covenant Working Group, if you look that up, that has a paper on integrated risk management and how covenant practitioners are looking at this and the sort of things that they are on. And obviously, in the marketplace, there are all sorts of different firms are presenting, just like we are today, our view of where this is going and how you can approach it. I think there's a lot of consensus, really, on the analytical framework. That circle that I put out of the different stages in it, I think there's quite a lot of agreement amongst practitioners that's quite a sensible way for a trustee board to take it stage by stage. And I think a lot of it is about proportionality. You do the best you can with the tools available and the budget available to you. Certainly, some of the largest schemes have been at the forefront of approaching integrated risk management. And there are certainly some very sophisticated discussions that I'm aware take place at that end of the market. Obviously, not every one of the, whatever it is, 5,000 schemes in existent DB schemes will have the capacity to do all this. But a good start is for all schemes to try and look at life through those sort of the lens of integrated risk management, and at least to start using the language of it. I had a question: how can a trustee board effectively demonstrate the use of IRM to the pensions regulator? Part of this comes back to governance and the trail of documentation. In a way, what the regulator wants to see is evidence that trustees are looking at life through this lens. So it's not a case of making sure your minutes are up to date and that you've got a sort of piece of paper which ticks a box. That's not the approach. But I think it's if you were to use some of the techniques that I've suggested and to, say, draw up a statement or around how you might look at what key risks have you identified? How have you thought about them? How are you managing them? That goes a long way to demonstrating to the regulator that you are aware of the issue. And again, the direction of travel. This is not a way of thinking that is going to disappear. And some of you will be aware of the DWP's consultation papers out on notifiable interest, a stronger regulator type of approach. And again, the language of integrated risk management is touched on in that. So this is the way in which the policy regulatory underpinning is going. Had a question about what can professional independent trustees bring to the IRM process. Well, I think they can bring an awful lot. Because professional trustees have the advantage of being able to look across their portfolio of clients and moving best practice forward. This is what they do. They are spending their time in trustee board meetings and are or should be aware of where best practice is. So I think there's a thought leadership piece here for independent trustees and professional trustees. And I suppose helping trustee boards who are individual trustees have got a lot on their plate. The lay trustees are unlikely to be heavily versed in this sort of area because it is if you grapple with it properly, I think it is quite a lot of sophisticated thinking really here because you're bringing together the various different disciplines and advice in one place that are pulled together for a pension scheme, and this is complicated stuff if it's done to the fullest degree. So I think trustees, independent trustees, have a very useful role here and should be encouraged in developing their thinking on, for that board, what is most appropriate to that scheme's circumstances. So it's a variable geometry, but I think a very useful role. I had a question. Do you think the regulator was right to suggest that legally enforceable contingency plans should become a standard part of IRM? I think the simple answer is no. I think that's too much of a blunt instrument. I'm always wary of a one-size-fits-all thing. And when you make something legally binding, it does change. It changes the dynamic really, because people then want to go into an awful lot of detail about what the various things. You can end up with an enormously complicated document. I have seen it. I've seen and worked on detailed contingency plans on contingent assets. They can be very useful. I mean, I'm in a transactional scenario and on some valuations, yes, legally binding contingent asset structures, for instance, can be very important because it binds in not just the current moral. It does more than just binding in morally the current company management team. But it binds their successors too, and it can't be ignored. So yes, it is as part of the menu of options that trustee boards have. Yes, that is very useful. But no, I think to say across the board, every scheme should be looking at life on a contingent on a contingency plan basis, which is legally binding. I think that's probably overplaying it. Here's an interesting question. Could better IRM have led to different outcomes in recent high-profile cases? And I suspect we all know the kind of cases under discussion there. So I suppose I better step back to say on a more general basis, without giving specific details there of how an IRM approach might have improved matters. I think it would have done, because the focus might not have been just on might not just have been a focus on a rather difficult trench warfare on contributions and arguments about how much money would go into the scheme. So that's what you might call a sort of a standard negotiations on recovery plans, but a more sophisticated view about what risk the schemes would be bearing on their sponsor in different scenarios would have been absolutely very useful. And likewise, I think from a governance perspective, for the company board, the risk that the schemes pose to the companies, and where the corporate comes back to corporate viability assessment on an integrated risk management basis, you really are digging a bit more into how does the company believe that it has a future over the long term? What kind of factors has the company taken into account? Look at that. Does the scheme funding present a risk to the company's profitability? Those sort of questions are very much integrated risk management questions. And I think if those kind of questions had been addressed around a table with all parties present, perhaps, it might not have, you can't change the eventual collapse of a company, but at least people would have known where they might stand if the company were to have collapsed. I think we have just time for one more question. Is about ownership of the process. I've mentioned that I think this is a trustee-owned piece, and how in practice could that operate? So that question has arisen generally, I think, on some schemes where people want to know, that's all very well about ownership, but actually how do we do this in practice? So I've touched on, I hope in this webinar, on some of the areas of how it works from a practical position. But I think the scheme, any scheme, will have obviously its named actuary and the actuarial and investment consultant. There'll be the lawyer. There will be hopefully the covenant person somewhere along the line. It should be really facilitated or assisted by those advisors who I suppose understand and can help the most. And it shouldn't be a competition between advisors. I think it should be a realism by each advisor of that some advisors will know much more and have a closer, long-standing relationship with the pension scheme, and there's sort of institutional knowledge about where things stand. So while I think from a governance perspective, this is very much a trustee-owned piece, I think there's a close interaction with the advisors around the table. Thank you very much, and I very much appreciate those who've taken the time to attend this webinar and to listen. And if anyone has any questions, please do email me or contact me at RSM. I find this subject one which is very worthwhile and very stimulating, and I really would value any contributions or discussions to try and advance this subject. Thank you very much for your time.